Hi everyone, this is Brian Neal with TradeToBeFree.com, and I want to go over a couple of trades that we took in earnings season here and show you a couple good tips here. One on overhead resistance and how that it can impact trades and not impact trades, and also talk about the long-term trend and how that plays into a longer-term swing trade versus a shorter-term swing trade. And right now I want to start with a shorter-term swing trade, which is the earnings eruptions strategy. A lot of you have the course and or are just looking for good gap plays. And earnings gaps are one of our favorites, and we only play the very best ones, the largest ones, the best stocks, with all the right technical characteristics and the best earnings beats and outlooks in the right industries too. So, but I want to show you a difference between a trade here that has overhead resistance and one that doesn't, and how that can affect how it plays out here. And the first one I want to show you is one we played, which was CyberArk Software, and this was back, I think, 2 or 3 weeks ago or so. This is back on November 6th. And this is how the chart looked that morning ahead of the opening bell. And we normally get in this soon after the market opens in the morning, and we watch how it sets up in the morning first and make sure it meets all the criteria in our course, in our strategy. But you can see that CyberArk has a really nice uptrend after the earnings beat and guidance raise. It had the conference call here. You can see that on Thinkorswim, which is really important. That's talked about more in the course, but it's got this real nice flat base pattern developing, or flat top developing before the opening bell, okay? And this looks really good. The problem is that if you bring up a 9-month chart here, you can see that this was back on November 6th, okay? And you can see that this pattern is a large rounding bottom pattern, which is good. If you go back further on a weekly chart, you'll see a long-term uptrend, which is very good too. I think this stock is just getting back above its 200-day moving average, and it has this overhead resistance, and that's what you'll find in stocks that are around the 200-day moving average in a long-term uptrend. And it's a really good setup. The problem is that you have all these people that got in, especially on this candle right here. We have all this volume. People got in here, okay, and they're holding the stock through this strong correction, and the stock went down, 20, 30% or so, and they're sitting in that loss and wondering if they'll get back to even at least, okay? That's human nature to want to get out near where you got in when the stock goes down that much as you're in the trade, okay? So you've got this overhead resistance you have to get through. And so there'll be this knee-jerk reaction for people, in some cases, to sell who got in this area after being down so much on the trade. All right, so that's one thing you contend with when you play these opportunities that have that overhead resistance. And we'll go back to November 6th now in this chart. Just going to scroll over here, and we'll zoom back in. And so that's the challenge that we notice before the trade triggers, and it actually triggered an entry a little bit later, okay, and we jumped in anyways. And what happens in this situation is one or two things, okay? Either it's going to get hung up here at this level as it gets into that resistance and turn over and pull back, or it'll break through the resistance and really take off. That's usually what we see, one of the two. So I won't necessarily back away on this trade, because if it does break through, it will tend to really run, okay? So I'll play this pretty much the same way as I play all of them, okay? I may take it off sooner if it doesn't break through, okay? And this had, 2-3 chances to break through and move a lot higher, and we ended up taking it off for a small loss on this trade, okay? Now, in some cases, what will happen is that it'll hit that resistance. It'll maybe come back a little bit, come back through and test it again, and then take off. All right, and with this kind of catalyst and this kind of stock, that's a real possibility. So I'll still play this, but I expect to see some kind of resistance and some kind of sideways consolidation at least before it breaks through, if it does. Okay, so the win rate will go down a little bit in this situation on a top growth stock. Now, most stocks, if it hits this resistance, will come back and show more resistance here and pull back further. But with these top growth stocks that we play, they'll more often break through and really take off. So, but the win rate is a little bit lower. Okay, I'm going to compare that now to another one we played, which was CDLX. And I know we definitely had this one in the alert service the night before mentioning it. And this was one of the best earnings trades of the quarter. And I'm going to go back here and look how this is setting up pre-market again. And you can see again, we have this sort of flat top base setting up ahead of the bell. This is a bigger gap, which is better. But if we look at again, our long-term chart, we can go back to even a 3-year chart on a weekly time frame. And you can see that heading into that breakout point in that strategy, you can see that we have no overhead resistance going back 3 years. Okay, and that's the best scenario. We don't have a lot of people that have bought around this level or above it that are looking to get out at break even. Okay, and we can see that hit the entry point. It immediately went up, 5-10%, pulled back, test the entry point, went for another wave higher. Okay, and it continued on, and we took off our final shares up here at like 57, I think it was, up in here, and that was like 15% above the technical entry point on that. So ideally you want to see no overhead resistance with your trade. Okay, I mean that's the best scenario. If we do on the best stocks and the best patterns with the best catalysts, it could still break through and take off. But we expect a lower win rate. And I believe that was the only loss that we took on CyberArk this quarter on the earnings eruptions trade. Okay, and that strategy out of like 5 or 6 or 7 of them that we traded. So still a really good strategy to play. Definitely worth trading. We just had fewer of them setting up because of the earnings recession that we've seen in small and mid caps. And I think the small cap earnings are going to be down like 22% this year. And so in that kind of environment, you're going to have fewer of these coming up. But when they do come up and they meet the requirements in the course, we definitely want to play those. And I want to show you also another one we played this quarter on a high type flag breakout. This one didn't quite meet all the requirements in the course. And it was setting up here and had that nice narrow consolidation in the flag portion of the pattern. And what I want to show you on this one is the double bottom pattern here on a daily chart. This is a daily chart going back 9 months, I believe. And you can see this double bottom here as it consolidates. And the consolidation pattern, or the double bottom pattern, is not only good for a long-term reversal pattern, it's also good for a consolidation pattern, actually, because you have different trends on different time frames. So in this case, you've got a long-term uptrend over the past year, 2 years, 3 years. Over the past few weeks, you've got this downtrend developing, okay? And this is, I'd call this more of an intermediate term downtrend here and consolidation. And within that, you've got the double bottom pattern. And then you've got the stock breaking the double bottom pattern here on the day we got in. So we actually got in on the double bottom breakout and also got in on the high type flag breakout. And those with the course were able to find this setting up, but we just kind of lucked out on this. We got in, and the next day it got a buyout rumor, and we got out pre-market actually using the course rules at around 73 to 75 after getting in around 57, I think was our cost basis on this. But that pattern within a pattern is a really good strategy to look for, okay? So not only do you have the long-term uptrend leading into the pattern, but you've got a real nice flag developing, narrow flag, okay, after the strong uptrend, and then you get a double bottom pattern also, and a breakout of that, and a really beautiful breakout right here with news that day, okay, and really good entry point, and then the breakout to new highs, we got in there also, and then we got the buyout offer the next morning, which just that happens once in a great while. And that that'll happen more often if you play these really strong patterns and these patterns that are very well formed. Okay, so if you got the high type flag course and you see those multiple patterns, that can really help. And we've got other videos on our YouTube channel, and the blog goes over the double bottom pattern and how to look for that within a long-term uptrend. And so I want to show you that too. And finally, I want to show you PayC, which is one of the ones we had in our alert service recently. And a lot of people wonder, which stocks they should play for a short-term swing trade and which ones they should play for a long-term swing trade. And this is a good one for a long-term swing trade because you can see on this chart how over the past 3 years on a weekly chart here, you can see a very strong uptrend. In fact, if you go back further, I'm going to bring up Stocktwits.com because I can get a better chart. You can read more easily on a 6-year time frame or weekly time frame on a 6-year chart. I'm going to bring up the ticker here, and you can see this beautiful uptrend going back to 2016, actually 2014 here, and how the lows would line up. If you draw a line connecting these lows, they'll line up pretty uniformly throughout the overall uptrend. Okay, so a really good long-term swing trade opportunity on a stock like this would be once it comes back to a support level. You can see how this 50-week moving average is acting as support throughout the trend here. Okay, and as it comes back and tests that area and starts to rebound, you can see the double bottom pattern here breaking out at 137.21 here. So you've got this low, a reaction, rebound here, and another test of that low, and then it breaks out here above this 137.21 area. That's a great entry point for a longer term swing trade. And we got one last week too, as it was testing this 50-week moving average. Okay, it had a strong weekly candle and a bullish candlestick pattern off of that. Okay, and it's breaking a prior high again in a double bottom pattern on a weekly chart. If we zoom in, we can see that better. And if you can take out the prior low with the second low in the double bottom pattern, that's even better, especially when it has a strong reaction like this off this moving average. And you get the entry point above 223. That can be an excellent entry point in a long-term swing trade. So we featured that last week just before it hit this point, or around when it hit 223. And those type of setups and those great long-term trends as they're testing the support level, okay, and rebounding, and that's why we said it was a good long-term swing trade opportunity. And it got off to a great start because the 10-year Treasury yield is moderating, and that actually improves or increases the value of the terminal earnings growth rate. So after 5 years or 10 years, whatever model they use, this stock is going to grow strongly for a while until it gets to a point where it can't grow that much more anymore. Okay, so what they do is they figure out, okay, how long will it grow in the next 5 years or 10 years, and then once it stops growing, what's the value of that earnings growth, that earnings and earnings growth rate, and they call that the terminal earnings growth rate from that point forward after it leaves its growth phase. Okay, so they're going to compare that value to the value of that earnings is going to be compared to the 10-year Treasury yield. Okay, and the 10-year Treasury yield is moderating and showing signs that it'll be lower for longer. Okay, that those out-year earnings will be worth more, and so these top growth stocks end up carrying a higher valuation because of that. Okay, so it's it's a little complicated, but if you want to look it up online, you can. But just suffice to say that a lower Treasury yield, 10-year Treasury yield for longer, tends to increase the value of these top growth stocks using the valuation models often used by growth investors. Okay, so knowing that helps too, and seeing the top software stocks and the top cloud plays and the top IPOs in the market that have that real strong growth currently, those out-year earnings are now going to be worth more because the 10-year Treasury yield is expected to be lower for longer. So that trend of declining yields continues, and that helps these top growth stocks. So anyway, I want to show you that and show you how these long-term trends can be played on a weekly chart and can offer a really good longer-term swing trade. And sometimes they get off to a real strong start like this. We caught a big upgrade this past week. Yeah, an analyst increased their target, their price target for this. And if you draw the channel going back 6 years, you can then project, the top of this channel, connect the highs here in this trend, and you can get to a pretty high target on this. Just expect a lot of consolidations, long consolidations. Like in here, you can see how they consolidated for several weeks before, and then how it moved towards the top of this upwardly rising channel. So okay, that's about it, guys. A lot of high type flag breakouts are taking off right now. Great earnings eruptions trades are still coming up. We had Target yesterday for a big trade, and a couple accounts here for those using the course. They're doing really well this quarter, and hopefully that continues. Usually November is great until the end of November, and then early December usually sucks, and then the end of December really picks up again. That's usually how it works during good years for the market. And of course, we'll keep on top of the current market conditions to see if that changes and if we see signs of a correction. But right now, things look good. Yeah, so it's a good time to trade, a good time of the year to trade. And of course, you have January to look forward to, which tends to be one of the best months of the year. So, all right, that's about it, guys. Best luck in your trading, and we'll talk to you again real soon.